Hi guys, and welcome to our podcast. Today we are going to understand how to choose the right type of life insurance. Death is such a morbid thing, so families hardly talk about it, much less plan on how to handle it. Having a good financial plan will help cushion the impact and stress of an untimely passing of a family member. It gives an assurance that the family will be financially unimpaired even if the breadwinner suddenly dies. Many financial advisors will quickly suggest a life insurance. After all, companies design their life insurance products specifically for that need. They take away the worries and provide peace of mind. But do you know what type of life insurance is the right one for you? Choosing the right one is the delicate part. Remember, getting a life insurance does not guarantee that you will be good financially for the rest of your life. It also doesn't assure that it will be sufficient for your family's needs in the future. Situations, circumstances, and financial needs change as time passes, and unforeseen needs may come in later. It is always important to review your life insurance policy after major events. You may have to make adjustments to your coverage. There are two fundamental things you should consider before you buy life insurance. The first is the duration of the insurance coverage. How long would a term be best? The second is your intention for getting insurance. Will it be an investment vehicle to receive cash after the coverage period is over? Let's start. First thing to discuss is the duration. This might be the most important item to consider before buying. If you need a short or medium period policy of around 5 to 30 years, term insurance is advisable. A term insurance is less expensive than other insurance types. However, term insurance doesn't really work for people who want coverage for as long as they live. People whose fixed obligations and regular income are higher usually prefer term insurance. They are attracted to the cash value feature of the plan because it somehow works like a retirement fund. Another reason for the choice is that the premium is more affordable. In a case like this, an investor should choose a plan with a good conversion option. Should they want or need coverage for a much longer time, they can easily change the policy. If an individual wants to have insurance coverage for his entire lifetime, a permanent life insurance is the right one. The insured will pay a higher annual cost, but in the long run, the net cost will be considerably lower. Also, many people consider the policy as an investment. The government gives life insurance as a special tax treatment. In most cases, the insurance proceeds are free from taxes. In other cases, tax on the accumulated cash value is on a deferred basis. So if you have the funds to invest, you can purchase a permanent policy with cash value. You will have to pay higher premiums, but while insured, you also build up an investment account inside your policy. This accumulated cash value has no restriction to use. Many investors use it to build funds for a new house, their dream boat, or to just simply supplement retirement. With so many insurance products in the market, it can be confusing to find what to get. Nevertheless, it's a very crucial stage of the decision-making process. Here are some guidelines to help you choose the best one for you. Let's start with term life insurance. You should consider a term life insurance if you need insurance for a specific period of time. You can make a term life insurance effective according to the length of time you need. If you want to build up a college fund for your young children, a 20-year term life would be sufficient. You would have the money by the time they are to enter college. Or maybe you want to pay off a debt that will become due in a few years' time. You can get a term policy for that period. You should get a term life insurance if you need a large amount of insurance but have a limited budget. This type of insurance pays only if the insured dies during the time of the policy. This causes the premiums to be lower than that for the permanent life insurance. If the insured is still alive at the end of the term, the coverage automatically ceases. The insured has the option to renew the policy or buy a new one to continue his coverage. Unlike permanent insurance, the insured will not be building equity in the form of cash savings. For investors who are anticipating that their needs would change during the period of the policy, there are convertible policies. Convertible term policies allow the insured to convert permanent insurance without medical examination. However, he would have to pay a higher premium. Typically, premiums are lowest when the insured is still young. As the insured ages, the premiums adjust upward. Some companies let term insurance policyholders renew their policies when it ends. They will, however, charge a higher premium. Some policies will require a medical examination before renewal for the insured to qualify for lower rates. The next step I would like to discuss is permanent life insurance. You should get a permanent life insurance if you want insurance coverage as long as you live. When the insured dies, whether he's just 20 or 100 years old, the insurance pays death benefits to the beneficiary. Get this insurance if you want to build up some savings that will grow on a tax-deferred scheme. The funds you accumulate could prove to be very convenient for your future needs. You could borrow from this fund and use the proceeds for a myriad of purposes. The good thing is, you could take out a loan against it regardless of your credit score. You could also use the fund to pay your premiums. You wouldn't have to dip in your pocket every month. In case you die with an outstanding loan, the insurance company will use your death benefit to settle your debt. If there's still something left from the benefit, the company will give it to your beneficiary. Premiums for permanent policies are higher than premiums for term insurance. However, they stay the same no matter how old the insured gets. On the other hand, premiums for term insurance tend to go up each time it is renewed. Permanent life insurance also has several subtypes. There's whole or ordinary life, universal life, and variable life. To know more about each type, you can read our separate article on these types of policies. Now I would like to go over some other factors to consider when setting the amount of insurance coverage. The first one is market participation and cash value of the policy. Insurance protection for the long term? Check. Potential to build cash value in funds you can borrow? Check. Lower premium? Check. If you need all these features, then you should consider permanent life insurance. The next question is, which of these three types of permanent life is the right one for you? Whole life insurance. This type of policy will build value based on a set schedule. Your insurer will tell you how much cash value your policy has at each anniversary. In case you have taken out a loan against it, your cash value will decrease accordingly. Universal life insurance. This type of policy will allow you to earn a fixed interest on the cash value of the policy. It states a minimum guaranteed rate. Over time, the interest rate may fluctuate, but it will never go below the minimum guaranteed rate. Variable universal life insurance. This type of policy will allow you to invest your cash value in the stock market. So, depending on how your investment performs in the market, your policy value goes up or down accordingly. The second factor to take into account is the length of coverage. How long would you need insurance for? If you need insurance coverage for a specific time frame, then term life insurance it is. For example, you might want to have protection while you're still paying off a mortgage. All other types of insurance will cover you for life as long as you pay the premiums on time. Fees and charges are another thing we should pay attention to. The expense side of insurance policies is not just about the premium. Some policies may have other charges connected to them. Before you sign the dotted line, make sure you know all the fees and charges you have to pay. Ask about fees you may have to pay in the future, too. In addition, make sure you fully understand the time frame for access to your money. Are you anticipating that in the future you will need to take out money from your policy? For example, you might have to pay for your children's college tuition. Most whole, universal, and variable products will allow you to withdraw money from or borrow against your policy. However, some policies will have restrictions on when you can withdraw, how much you can borrow, and the interest rate. The last thing is the flexibility of your payments. There are universal and variable life insurance products that will let you make flexible payments. This comes after you have paid enough to cover your policy charges. That's it for now. On our website, you can find more posts and podcasts as well as calculators and other financial tools. Which type of life insurance do you think is better for you? We would love to know your thoughts, so feel free to share them on the comments below. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. Thanks, and we'll see you next time.